Have you noticed that every few years, headlines scream, "The rupee hits a new low"? But what does that actually mean? If yesterday, one US dollar was worth 80 rupees and today it's worth 86 rupees, it means the rupee has weakened. In simple terms, you now need more rupees to buy the same dollar. But why does this happen? Is it because India is poor? Is it because of government policies? Or is there something much bigger going on? The answer lies in three major forces: oil imports, gold imports, and foreign investment. Let's understand how these three factors quietly influence the value of the Indian rupee. Think of currencies like products in a marketplace. If many people want to buy dollars, the demand for dollars rises. And when demand rises, the price goes up. For India, this means more rupees are needed to buy $1. The rupee's value depends on supply and demand. If more dollars enter India than leave, the rupee strengthens. But if more dollars leave India than enter, the rupee weakens. Now let's see the biggest reason dollars leave India every single day: oil. India imports more than 80% of the crude oil it consumes. And here's the catch: oil is mostly purchased in US dollars. Imagine global oil prices suddenly rise. Indian oil companies now need more dollars to buy the same amount of oil. To get those dollars, they sell rupees and buy dollars. This increases demand for dollars and puts pressure on the rupee. When oil prices remain high for months, billions of dollars flow out of India. That's why rising oil prices are often followed by a weaker rupee. Indians love gold. Whether it's weddings, festivals, or investments, gold demand remains huge. The problem? India imports most of its gold from other countries. And just like oil, gold is also purchased in dollars. Whenever gold imports surge, Indian importers need more dollars. This creates additional demand for dollars and increases pressure on the rupee. In years when both oil and gold imports are high, India's trade deficit grows, and the rupee often faces even stronger downward pressure. Now let's talk about something that can actually strengthen the rupee: foreign investment. When global companies invest in India, they bring dollars into the country. These dollars are converted into rupees to build factories, hire employees, and expand businesses. More dollar inflow means higher demand for rupees. This often helps support or strengthen the currency. That's why governments work hard to attract foreign investment. It doesn't just create jobs, it also brings valuable foreign currency into the economy. Unfortunately, foreign money can also leave. Suppose global investors become worried about inflation, recession, or better opportunities in another country. They may sell Indian stocks and bonds and convert their money back into dollars. This sudden demand for dollars can push the rupee lower. Sometimes, even if India's economy is doing well, large foreign outflows can temporarily weaken the rupee because currency markets react quickly to capital movements. So why does the rupee fall? Three major reasons stand out. First, India imports massive amounts of oil using dollars. Second, gold imports create additional dollar demand. And third, foreign investment flows can either strengthen or weaken the rupee depending on whether money is entering or leaving the country. A falling rupee isn't always a sign of economic weakness. Sometimes it's simply the result of global oil prices, investor sentiment, or trade dynamics. The rupee's value is really a reflection of how dollars move in and out of India. And now, the next time you see a headline saying "rupee falls against dollar," you'll know exactly what's happening behind the scenes.